Hello everybody. In this video I will be going over chapter 11, the money markets. And just a quick note before I start, this is actually just chapter 11. The exam covered up to chapter 8, and since we have gone over chapter 9, 10, and then this will be 11, so I will post a quiz tomorrow, and that will be available over the weekend. And then chapters 12 and 13 are the bond market and then the stock market. So there's quite a few more quantitative problems compared to these other chapters. So after I go over that, I will post another quiz that may be the end of next week, and it may be the middle of the week after. So I will keep you posted on the next couple of quizzes. And then, of course, we will be having the final exam before too long, a little less than a month, I believe. I will obviously also update you all on that. So chapter 11, the money markets. So this kind of introduces this is obviously a good segue into the bond market and then the stock market. So there's a few quantitative problems here, and I'll go over one example. But again, like I said, the next two, there will be more. So expect that coming up. So money markets, they start off, obviously review the slides, as you always do, by saying that it's actually a misnomer because the instruments that are in money markets are not actually money. They just call it that because it's close enough to money, because they're very liquid and they are investments, but they're not nearly as risky as like the stock market or even corporate bonds. So they're not really money, but very liquid. And there's three other things that are attributes of the instruments in money markets. They're usually sold in large denominations, so of increments of $1 million or more. They carry a very low default risk, like I said, and they mature in 1 year or less, and in most cases less than 120 days. So they're very short-term, very, very low-risk assets. So why do money markets exist? And the biggest reason is because of regulation and asymmetric information, which of course we've talked about now for a couple of weeks. And essentially, banks are better at mediating between borrowers and lenders typically when there's a lot of asymmetric information. Like if you're going to buy a house, the person or the company who made the house, maybe they don't trust you to pay them back over 30 years. So obviously a bank steps in, pays them, and then you pay the bank back. So when asymmetries are very low, money markets are actually cheaper because, of course, in that scenario where you go through a bank to buy a house or something like that, obviously the bank is charging you for that. They charge the lender. So the benefits of money markets, a quick summary is investors on the investment side, they can invest surplus funds for very short periods of time. So if a company has a bunch of cash laying around and they don't have, necessarily maybe they don't have an R&D project they want to invest in right now, if they're not going to do anything else with it, they may as well invest it in a very low default risk investment because at least they can earn some return on that money rather than just letting it sit there. And on the other hand, borrowers can get very low cost funds for short periods of time. So an example of this, as I went over in either chapter 9 or 10 with the federal funds rate, banks can lend to each other for short-term liquidity needs. And again, it's at very low rates. So here are some of the money market instruments. So first, the prime rate, which right now is about 3.5%, or I guess at the time of this book, which is a couple years ago now. So this is essentially the best, in quotations, lending rate that a bank would offer. So this is for people with the best credit rating. Next is a federal funds rate, which I already talked about in I can't remember if it was chapter 9 or 10, but you can review both of those chapter slides in the video. And the next is commercial paper, which is a little bit more than the federal funds rate. So that's because it's sold by corporations to meet short-term debt payments. So it's almost their form of like a treasury bill, where that's why it's a little bit more, because technically corporations could go default, unlike the government, hopefully. But it's sort of the same type of thing. It's just if they have an upcoming debt payment coming up in very short term, they can issue commercial paper, and it's just a short term thing. Well, they'll pay the lender back that very small interest rate. And now the Eurodollar and the London interbank offer rate are very closely related, and I think can be a little confusing. So if y'all have ever heard of the LIBOR rate, that is the benchmark rate for bank-to-bank lending. So that's what I was just saying with, so the Fed can try to influence this rate with their monetary policy, as I talked about in the last chapter. So again, this is just a benchmark rate for bank-to-bank, short-term bank-to-bank lending. And now the Eurodollar is corporations in the United States, when corporations in the United States keep money in banks that are outside of the United States or in Europe. And this is a derivative for LIBOR futures. So as we talked about in the chapter 9, I believe it was, it's just a financial instrument, essentially. And these are used to essentially hedge risk for the, so this is based on future LIBOR rates, or LIBOR futures, they call them. So perhaps banks would want to hedge whether the LIBOR rate is going to go up or down in the future and protect against it fluctuating. And lastly are treasury bills, which of course I'm sure we've talked about a lot. Or in other words, these are called T-bills. So this is just the shortest maturity government bond. And this is also what they call the risk-free rate. Now on to discounting. So discounting is when an investor pays below face value for a money market instrument. And so obviously that would be, the present value would be less than the face value, or what would be paid at maturity. And they have, I thought this also could be slightly confusing, and it's just a very small difference here between these two interest rate calculations. So of course, again, the discounting would be when this is less than this. So for a discount, if a question asks you for the discount rate, it's 360 days divided by n. But if it's the investment, it's 365 days. So it's just a subtle difference. But if you were asked that question in a test or a quiz, that could be enough to throw you off of the correct answer. So just please remember these two. Just a very small difference. Where n would be the number of days until maturity. So questions may ask, I saw one at the end of the book that asks you about the investment rate, and then what would you have to get, what would that return be in terms of a discount rate instead? So it's just that 5-day difference. Next, I thought these slides were, again, please go over the slides. I thought these two were pretty confusing as well. So there is a competitive bid, and that's when investors, so this happens when each week the government announces how much of their treasury bills they want to sell. And of course, then they get bidders or investors that want to buy those. So there's two types of bids that go on in that process. The first is a competitive bid. So that's when each investor state the price and the quantity of those treasury bills that they want. And then there's a non-competitive bid. That's when they only state the quantity that they want. Essentially, those who engage in a non-competitive bid are essentially saying that they are willing to pay whatever price. They only list how many that they want. And of course, the Treasury always wants the highest price. So if they get multiple bids, they're going to fill the ones that are at the highest price first. And that's what's going on here in these two slides. So let's say in 1 week, if the Treasury announces that they're auctioning $2.5 billion, par value 91-day T-bills, then let's just say that the following bids were received. So of course, this bid amount here adds up to more than $2.5 billion. So they can't fulfill all of that. They're not willing to do that. So an important part here too is the Treasury. They say they also received $750 million in non-competitive bids, and the rest of these up top, these are competitive, and then this one's non-competitive. So the way that would work is, like I said, just your intuition tells you obviously that the Treasury is going to want to sell that $2.5 billion to the bidders who bid the most. So first, if you look at these bid prices, where I have a 1 here, that's obviously the highest price. So first they're going to sell that $500 million to bidder 1, which you can see here. And then the second highest price is here, the 2. And then they're going to sell that to bidder 5, as you can see here. So that's pretty straightforward, that's pretty easy. But then the third highest price is where I've marked the 3 here, 0.9936. So at that point, the reason that they don't, and this bidder wants 1 million, so let's add this up. So the first 2 highest are pretty straightforward, the 500 million to bidder 1, and then the 600 million to bidder 5. Of course, that equals 1.1 billion. And they still want to sell 2.5, so they still have 1.4 to go. So the non-competitive bidder at 750 million, again, is essentially willing to pay the highest, where I say, quote, highest price, where it actually comes in at the highest that's going, or the lowest of the bids that got accepted. So because of that, so if this 9936 ended up being all 9939, they would have paid, the non-competitive bid would have paid that price. Or if they all came in at 9940, the non-competitive bidder would have paid that price. So what's happening here is, since they have 1.4 billion left after bidders 1 and 5, then it goes all to the non-competitive bidder. So that's another 750 million. You add that up to the 1.1 billion, that's 1.85 billion. And that's not shown in the list here. That's just shown here. So now they're up to 1.85 billion. And again, the important part here is that because they issued a non-competitive bid. So they get first dibs, essentially, at that highest, or the lowest of the high prices that are accepted. And then, as you can see, bidder 4 here wanted $1 billion, but there's not $1 billion left. So what is left is 650 million. Because then that 0.65 gets them to 2.5, and that's the 2.5 billion. So that's how that works. That's the reason bidder 4 only got 650 million when they wanted $1 billion. But bidders 1 and 5 got exactly what they wanted because they offered the highest bid price. So if anybody has questions about that, please let me know. I thought it was a little confusing. So, and again here, there's more definitions. And just please go over the slides as always. And then I did want to go over, so there's quite a few quantitative problems here, but I'm going to save some of those for the quiz, but they're all based off of these 2 formulas here. So depending on the wording of the question, you are asked to find obviously one of these variables. So they might give you everything except this, and then you solve for that. They might give you everything except for the number of days, and you solve for that. Or they might give you everything except for the face value, and you solve for that, etc. So just pay attention to the wording, and you just have to rearrange these formulas as necessary. So I will do one example. If anybody wants more examples, just let me know. So if you want to earn a discount rate of 3.5%, what is the max you would pay for a Treasury bill with 91 days to maturity and a face value of $5,000? So again, an important part here, they're asking for the discount rate. That would be different if they asked for the investment rate, discount investment. And again, the difference is that number of days until maturity in the numerator here. So again, here's the formula for, again, the discount rate, not the investment rate. So you just obviously set this equal, because it's saying you want to earn 3.5. They give you the face value of 5,000. Since it's the discount, you use 360. It's a 91 day to maturity, so there's your 91, and then you just solve for PV. the present value. So that's what you would pay today to earn that rate of 3.5%. So obviously here I'm just doing a little bit of algebra, rearranging the equation, and the answer is here. So again, it's just depending on the wording of the question, you're going to have to solve for different things, but it's all based on these two equations. And just again, please remember the discount corresponds to 360 days, and the investment rate corresponds to 365 days. So that's all I have for this chapter. Again, the quantitative problems are not difficult. Just please review the slides. Let me know if you have any questions. And again, next week, or maybe the next week and a half when I go over the bond and stock market, the quantitative problems will be a bit more difficult, or at least there's going to be more of them. So please stay tuned for that.